Welcome to Driven, the Unscripted Success podcast, with your hosts, Mike Menino and Nariman Hamden, bringing you insights and stories on achieving personal, professional, and financial success.
Hi, everybody. This is Michael Menino. Welcome to Driven Unscripted Success podcast. Today on the podcast, we're interviewing professionals who will share their experience and tips with you, the audience, on how they got to where they're at today, and zooming from the beautiful island of Mario. Where are you from?
Naples, Florida.
Naples. Oh, that's a beautiful
almost
area.
Like an island. Yes,
it is. I had someone from Fort Myers, and they said, "Yeah, you're pretty close." It's got that big, that big causeway going through Fort Myers. So Mario, do me a favor, tell the audience about yourself, what you do, and we were talking a little bit off camera about what you do for a living.
So I've been investing in real estate since 2006, owned a real estate brokerage before then, but was mostly flipping single family homes. And then in 2013, started buying mobile home parks as an investment. And since then, we've continued to invest in mobile home parks, but also own some self-storage RV parks and light industrial as well. But I would say my main business is investing in mobile home parks. And we have an education company around how to do that. We have a property management company that supports that and several other kind of supporting businesses in that industry.
Awesome. That's fantastic. What do you like better? That's the one area that I've never been into. I've been into building, construction, flipping, contracting, and multifamily, but mobile home parks and RV parks, that's new to me. What do you like better?
Out of
the ones
two?
That make more money.
Out of the two?
Yeah.
I prefer mobile home parks over everything.
Really?
Yeah. They're not a sexy property type, but they cash flow very well. They're very stable assets, and we can get into all the benefits of owning mobile home parks, but there's some very unique aspects to that property type that you will not find in any other property type. And especially when you start to stack them or layer them, it becomes very, very attractive from an investment standpoint. Yeah.
Well, give me your highlight reel.
All right. Well, so I would say that the biggest benefit to buying mobile home parks is you can't build them anymore. So you have more of these being redeveloped into other things. And look at it this way. You've got very high demand because of affordable housing with a decreasing supply. You can't develop them because zoning won't allow it. And you got more and more people needing it every single day. It's really good to own a mobile home park because every day you lose competition. When I buy a mobile home park, I never worry about somebody building one across the street and then, dropping rents or doing concessions and causing me to have to back down rents or caused vacancy. I mean, it's very attractive from that standpoint. Additionally, there's this whole transition going on right now. It's called consolidation, and it usually only happens in an industry one time, and it's happening right now in the mobile home park space. And what that looks like is mom and pop developed these parks in the 1950s through the 1990s, you could say, and now they're dying and retiring. So professional investors like you and I are going in and buying up these properties and running them like a professionally run property. And we understand the valuation. We understand the cash flow benefits. We really know how to run them like a business. And then behind us is the institutional investors that are floating around looking for portfolios to buy up. And that's the spread. You can buy it at a really good price from owners who have not really taken care of them, who have not raised rents, who have just let the properties go. We can make all the improvements, force the value up, and then sell them to the highest paying buyers, which is the institutional investors sometime down in the future. So between those two things, demand, supply, consolidation, as well as not being a very management intense property once they're stabilized, they're really great investment. Last thing I'm going to point out, expenses. We have less expenses in a mobile home park than most other properties. And what that means is I actually get wealthier buying mobile home parks than buying anything else. And what I mean by that is if an apartment building, which most people are pretty familiar with, if you bring in $100 in income, 50 cents of that, $50, it's late in the day, $50 of that 100 goes out to expenses, which means I get to keep $50 going to the NOI. And as you know, commercial property is valued based on the NOI.
Mhm.
And I get to keep, when I buy a mobile home park, about 60 cents on the dollar, which means I have lower expenses. Therefore, I get to keep 60 cents or $60. And when you value that extra $10 or 10 cents, that adds up really, really fast. So for every dollar I bring in, I actually get 10% wealthier, not only in cash flow, but also in net worth by buying a mobile home park versus most other property types.
We're into the multifamily space, and I could debate you on one quick thing.
Bring
I
it.
hate to do this. You want to bring it?
Bring it,
All
man.
right.
Why not? I like
So,
multifamily too.
yeah, multifamily is great. Mobile home parks is multifamily.
It is.
Yeah, so
It's just a segment of, yes.
correct. It's the same thing, so you're 100% right on everything you said. The one thing that we like doing is cost segregation. So we buy an apartment complex, and then the toilets, the cabinets, the countertops, the flooring, the appliances, all depreciate over time. And so we get a huge tax saving when we do a cost segregation. We segregate that all out, and on year one we can get a 40% depreciation. So let's say you invest $100,000 into a multifamily, you save $40,000 on taxes that year. So that's one of the huge benefits that you get from multifamily, because there's more toilets, and there is more. You're 100% right. At 50%, sometimes it's more because of your expense ratio. But it is more work. But the tax savings is what I could say is the only thing that would be better. Yours is less work.
You said you wanted to debate on your podcast, right? Okay.
Well, let's do it.
All right. So actually, mobile home parks, RV parks, and golf courses are the best tax efficient property you could buy. Where you said 40% is typical with apartments, which is true, it's between 70 and 90% for mobile home parks, RV parks, and golf courses. So when I have an investor that writes a check, they get massive depreciation, because if you think about it, we don't have all the buildings. Buildings depreciate slower than infrastructure. And so we have a faster depreciation schedule. So an investor gets bigger bonus depreciation buying mobile home parks, RV parks, and golf courses. So
that's interesting.
Ask your
like
cost seg guy that. Just say, hey, what's the best properties for cost seg? Storage
I'll
is
do it.
pretty bad. I mean, I own
storage. You don't have
stuff.
anything to depreciate. It's all steel and cement. That's the
Industrial,
worst one.
same thing. Yeah.
I agree wholeheartedly. That's awesome. Great. We could have a great conversation on that.
Let's do it.
There's a lot of competition in your business, and what's in your space. There's a lot of mobile homes out there, and a lot of people looking for them. What sets you apart? What keeps you up? And what do you do that most people find challenging?
I was just talking about this on my coaching call today. The difference between the successful mobile home park investor, and really real estate investor in general, versus the non-successful one is two things: consistency multiplied by volume equals results. You can have very high consistency multiplied by very low volume. Doesn't matter. From a marketing standpoint, you're not going to get results, right? If every day you call one property, you're not going to get much results. On the other hand, if you have very poor consistency, but every time you do it, you call 150 properties, again, you're not going to get a lot of results. So when you combine those two things together, consistency multiplied by volume, seems very simple, but you actually get the results. And I would say that our results have just come from 13 years of dialing owners every single day, building the relationships, doing all direct to owner. We don't deal with any brokers at all. Like, we've never bought a park from a broker. So everything is all direct from owner. And it's just constant, ongoing, high volume, repetitive marketing strategies that aren't sexy. It's really not. Like, there's nothing pretty about it. It's just doing it over and over in high volume.
I've noticed on the properties we got through relations, it's usually timing too. Like, you just become friends with the apartment owner, or mobile home park, and just talk to them. Hey, what's going on? Would you like to sell? No, one like to sell. Do you mind if I keep calling you? Nah, go ahead. And then one day they're like, hey, you know what? Now's the time.
Yes. That's the consistency factor.
the consistency factor. And that seems to get more than anything. It really does. When you just call at the right time, someone died, something happened, they want to get out.
Yeah.
But when,
That's it's exactly what I'm talking about. When you consistently follow up over and
yeah,
over and over and over and over and over, something changes. They know you. You've followed up with them consistently. There's a relationship there, and you're the first person that they think of or the first person that they talk to. But if you call 1,000 people one time, you're not going to buy much. If you call, you know, if you call one
500
person a
people,
1,000 times, you're not going to get much. It's a combination of the two. Yeah.
I agree with that wholeheartedly. That's been one of our mitigating factors is just contact. And then for us, broker relations seems to work well too. But if you've got that, you don't need the broker relations.
Yeah. Yeah. And there's nothing wrong with brokers. We've just found that it's hard to make deals work when you're really working with someone who's educating the seller and trying to get the seller the highest price they can. Typically, they're working for the seller, not always, but usually they're working for the seller and they want to get that seller the highest amount of money. And so, I'd rather work with someone who doesn't understand cap rates and doesn't really care about them. They just want to get a certain dollar amount and they don't have somebody in their corner. It's like they've hired an attorney and I'm going against their attorney. I don't like that. So
Right.
now,
Exactly.
on the other hand, when I sell, I always list it, right? And I
Right.
want maximum exposure through a brokerage because I want to get the highest price. So I don't buy the same way I sell.
Right. No, that's a good business plan. Do you have this is a question for us businessmen. Do you have a simple way to evaluate a property um, with quick numbers?
Sure. Yeah, we just take total occupied lots or paying lots, you could say, multiplied by the lot rent, multiplied by 12, so that gets you your gross revenue,
Mhm.
multiplied by the expense ratio. And in this case, call it 40% expense ratio. So you'd multiply that by times 0.6, gives you your NOI. And then you would just divide that by a cap rate, and that would give you a general idea of the value. Now, that doesn't necessarily mean you should offer that price because that doesn't take into consideration a lot of factors such as CapEx, closing
CapEx.
costs, interest, like all the different factors that don't get figured into a cap rate, but gives you a good idea of, hey, is this person smoking crack or are they within range of a deal being
Of a
made?
decent offer.
Right. I mean, are they just on cloud nine and they're just asking something stupid, or should we at least talk further? And I typically just do a 10 cap on the top of my head. I can tell if I'm in range, or not from where I need to
Gotcha.
be.
Yeah, 10 cap's a good cap rate for any multifamily.
Yeah, and I would say that, it's not often that you're buying it at a 10 cap on existing P&L, but by year one, stabilized, or year two, depending on the business plan, we want to be at least a 10 cap stabilized. Yeah.
Awesome. That's fantastic.
Yeah.
Um, if someone you got a lot of good qualities. If someone listening now wants to get better at what you're doing, what is the advice you would give them? What suggestions would you give?
Yeah. Well, one thing that I would have done differently starting over, 13 years ago doing this, I would have probably figured out what my skills were and what I really enjoyed. And I would find someone who was really good at the things I wasn't good at. I did it the opposite way. I kind of did everything myself, built out a property management company, built out the whole business. It's great. Now we have it, so it's beneficial, but it also slowed me down a lot in my
Hmm.
growth. I'm not an operations guy. I'm a capital and acquisitions. Like that's my strength. I love the people side. I love, talking to other business owners, buying their property off them. I like the negotiation. I like all of that. When it comes down to turning the wheel and just doing property management type things or even asset management, I can do it just fine, but it's not my strength and it burns me out pretty fast. And so if I was going to start all over again, I would recognize my strength and then I would go find somebody who's really good at the property management, project management, and asset management roles, and I would partner with them. And I would just go nuts in buying and raising capital and let them take those deals and operate them correctly. You can kind of do that with third party management, but it's not the same. And I would say that anyone who's looking to get into commercial real estate in general should look at it slightly more as a team sport than just an investment. The other thing that I would say, I made a big mistake. I was actually looking for apartments for a year and a half before I bought my first mobile home park. And it was going back to like 2011, 2012, dates me a little bit, but I was out looking for apartment
You don't look
buildings.
old enough to be in the business that long
Yeah, I
ago.
know. Yeah, if I shave, then I really don't. Um, but I was out looking for deals. And prior to that, I was flipping houses. That was my
Mhm.
business, right? And when you're flipping houses, you realize and recognize that although you're an investor, you're really running a business. You're in a trading business. You're buying an asset, repositioning it, and then selling it. Well, when I went and started looking to buy apartments, for some reason, I took off that business hat and I put on my investor hat because I was going to buy cash flow, right? And so what I started doing is I started thinking like an investor. What do investors do in the public equities market and the bond market? They pretty much get on a computer, scroll and search, they research, and then they just buy it, they click buy it, and it produces income, right? I mean, that's generally what they do. They don't run a business. Investors don't
No.
run businesses. And so for the first year and a half, I was looking for apartments, just talking to brokers, searching LoopNet, Crexy, hoping for deals to pop up, and nothing ever did because I didn't have a business model around it. I was just hoping to luck up and find a good investment. Once I realized that I was actually in the real estate investment business and I needed to create a machine, a system that would produce deal flow for me and that I could systematically underwrite and acquire things, that's when I started getting deals. And it just so happens it came through a mobile home park first, which was kind of funny. But, and then I just went crazy on the mobile home parks after that. But that being said, I had to take off the investor hat and forget that. My investors who gave me the capital, they're investors. I'm in the real estate investment business. And once you start
Right.
thinking that way, you can actually create deal flow in a pipeline.
Yeah, I agree with that wholeheartedly.
Yeah.
100%.
Yeah, you're really in
Um,
the, especially if you're raising money, you're really in the private equity business is what you're in, and the real estate management business.
exactly. And like you said, I partner with people that are really good at what they do. We just acquired one that I can't really talk about. It's a 506B and it's not fully funded yet, but we just acquired one, and the sponsor himself owns the property management company, just like you do. And that's who I want to work with because I don't want to deal with tents and toilets. And he's got 1,200 of his own units in that area. So he knows the
Yeah.
area, he knows the people, he knows the income, he knows everything about that area. And you partner with those kinds of people, and it really is hard to fail.
It's the best. I mean, if you are an acquisitions type personality, or even on the capital raising side, you can really position yourself well by partnering with an operations person because all your work is front loaded, right? You're going to source the deal, which means you take a lot of risk. You put in a lot of time for a lot of crappy deals that fall apart, and you spend some money and time. But once you close on it, your workload just dramatically lightens. And now you can go focus on buying the next deal and scaling your portfolio faster because someone else who's really good at the operational side can just turn that into a machine, right? And so I didn't do that. And it took me longer to get,
Yeah,
to grow than it could have. So
I agree with you wholeheartedly. The best part that my partner said was on this deal was yeah, no, property management company is just not a money making company. And I just looked at him and go, that's why I don't do it.
right.
I was like, that's what I'm glad you said that because right? And
Yeah,
that's not a money making
it's
business.
not.
But now he's going to operate that units, and it works out fantastic. I
It's
agree with everything you're
necessary
saying.
evil, right? It's like you need the property management company. Somebody has to have the property management company. It's not profitable, so you better be getting a good stake in the deal to make it worth it. But when you have the machine, it's really good. You can use
Hmm.
it and it's an asset to you. But if you don't have to have the machine, it's even better because
Right.
it's not
Exactly.
profitable. Yeah,
Well, partner with people that do what you don't want to do. And I'm
exactly.
much better at raising money and finding the deals and, getting the right people on board. I'm good at building teams.
Yeah.
That's
Yeah.
that's what a that's as a builder for 30 years. That's all we do is, you get a bunch of electricians, carpenters, framers, roofers, and siding guys, and build a house.
Yeah.
Now it's just um, equal skill sets to find a property manager, find a deal, find the investors, and it's the same thing. It's building. There's 100. I think there's 1,000 people building a house, and there's like 10 partners on a deal up to. So it's
Yeah.
it's easier. One tenth the effort.
Yeah, for sure. A lot less moving parts for the most part. So yeah, I agree.
Exactly.
I mean, even if I think my mindset was, number one, I just didn't think to do it, but also I wanted to keep as much of the deal as possible. And yeah, in some sense, look, I envy the guy who owns, 30 commercial properties with no partners. That's pretty cool. Like, that's pretty nice. At the same time, I wasn't positioned to do that and I didn't go that route. So, for me, I'd rather own a smaller piece today than and not have to do everything and be responsible for everything than to have the majority or all the ownership and everything, but have to be
Yeah.
responsible for it all.
Yeah. And yeah, it's your butt when it goes down. I agree with you wholeheartedly.
Yeah.
What is one of the biggest challenges you had overcome in your career?
Well, I had a really bad financial situation. My first business I started was in high school, right after I turned 18, and that business went really well for about 3 years. And then we were contracted. It was a marketing company. We were contracted by one vendor or one supplier, really, and they filed bankruptcy, so they
Oh,
cut us off. And here I'm thinking, I'm like 21 years old, thinking I'm going to be retiring in the next couple of years, or not literally, but could, because business was going so awesome. And when you're that age, that's all you think about is like, how can I ball out of control at the earliest age possible? And then they filed
ball out of
bankruptcy.
control. That's going to be the
Yeah.
name of the podcast.
Yeah. And then they cut me off completely. So I went through a
Oh,
lot of financial struggle very early on in business, and I'm thankful for it because who gets to get wiped out at 21? Like,
right.
that's so much runway, and I learned so much from that I was a much more, conservative investor, a lot more reserved, a lot more focused on risk and taking into consideration risk and not just being completely blue sky optimist on everything. And that really helped me. So I would say that, so that really hit me hard and it messed with my head. But I think ultimately the long-term benefits of it were great and made me a much better investor and entrepreneur. But I think getting out of that was a struggle, not just out of the financial situation, but out of the credit, just out of the whole mess of trying to break myself away from that and reinvent myself. That's hard mentally to do. Anybody who's been through, real bad financial situation, it messes with you. And so I had to not only get myself out of it, but I also had to prove myself again. I had to show that, like imagine raising money and several years before getting wiped out. That's, and having trouble getting bank loans and things like that. I had to reprove myself and build that up. And I just
Was
take,
this during 08?
yeah. Yeah, I
Yeah,
mean, it was
you're
right
not
around
alone in it.
it was right around 2008. It was right before it because I had that. So that business went out of business, and then probably a year that would have been like 2006. So I got hit, and then everybody else got hit right behind. And get this, my first distressed deal, okay, that I ever did on a short sale was my own house. And that
Oh,
actually
wow.
that actually taught me how to do a short sale. I was trying to sell this house. I was upside down because so my business went under and now I'm holding this house,
Right.
and it's upside down. And then the market crashed right behind. So I couldn't sell the house. So not only did my income fall off, but then my house was worth nothing. And all these people would pass on it. And then one guy came and he was like, I'll buy it. Like, okay.
For a reduced rate.
Something's going on. How does he know how to buy my property and work with the lender. And this is like, because it happened before really everything crashed, nobody was out buying short sales yet. He was very early to the game. And he's like, yeah,
been through it before.
well, yeah. And
Was he a little bit older?
Little bit, not crazy
Yeah.
old, but he had the trick to the short sales before anybody was doing them. And I was like, oh man. So I learned how to do short sales, and immediately after that opened a real estate brokerage, and we started doing short sales like crazy before a lot of people were doing them. So it ended up giving me a real edge in the market, in the brokerage world. And so yeah, anyways, that's
No, that's an entrepreneur. So you went through a horrible time,
yeah.
and you found some good in it. You know what I mean? That's rare.
If it didn't happen, I don't know
You
what I'd
wouldn't
be
be in
right
short
now.
sales. You wouldn't know how to do a short sale.
Would have never bought real estate, probably.
Wow.
Yeah, probably would have never gotten into real estate. I take that back. Maybe we had I did wholesale a couple of properties. So yeah, maybe that's not so much, but I definitely would not have gotten into it like I did, because I wouldn't have been knowing how to get into the distress stuff like I did.
You ever do a sub two?
Um, for a short time, yes, but ultimately to flip out of it. I've never done any sub 2 deals to buy and hold. I've never rented single family homes ever. So
Really?
yeah, I've only flipped single families. I bought a fair amount of notes, bought a lot of non-performing loans. And then of course the commercial stuff I bought and held. But the first mobile home park I actually bought was a non-performing loan, foreclosed on that and took it back. And yeah,
Nice.
but never rented homes.
I did, but it worked out real well for me. So I'm always the kind of guy that has more than enough runway, capital to keep everything going.
Yeah.
And in 06, 07, I could see the writing on the wall, and I sold off all my properties that were I built a big beautiful house and sold them. One of them I sold for $15,000 profit, and it was a $650,000 house. All the other builders were laughing at me, and I was like, all right, let's see what happens. And about 2 years later, everything crashed.
What were they selling for then?
So the person, I hate to say this, is a real good guy. He was a paintballer, and me and my son were paintballers at the time. The guy I sold it to is one of the nicest guys I've ever met. He lost it, because he was he was my foundation guy for building houses.
Yeah.
And I met him after I sold the house to him, and then he lost it to the '08 problems, and that taught me a little bit of something. But I started buying houses. I had construction crews, and I had some guys, and I wanted to keep them busy, right? Because I didn't want them to go anywhere. And so a friend of mine, the realtor, said, no, a friend of mine goes, I got into flipping. He goes, hey, there's a house for $15,000 in Oxford, Michigan. I'm like, let me look at it. And I looked at it. I'm like, all right, I bought it. And I put my guys in there for a couple of weeks. And there was one across the street I bought for 15. I swear to God, you can't make this up. I bought one house for 14,500. Went to the tax sale. I told my wife, I said, you buy the one in Oxford if you can buy it. She bought it for 14,500. It was directly across the street. I own 20% of that street, and then I rented them out. And this is for single family. I'm in multifamily now. I love it way better. But this kind of got me into flipping. And then I got 5 or 6 more houses, and fixed them up. And then I just wanted to rent them out. And then when the tides turned, I sold them, which was probably my biggest mistake. Is everything I bought I should have kept.
Yeah,
I think
the we've all said that.
And even to this day, we're flipping houses in Michigan, and we should hold 1 out of 5, and we don't do it. We just like making money. But
yeah, it's hard to turn down a big check when it comes on your, it comes to you. It's like,
yeah,
that coming.
I know the feeling. But what I do like is we put the assets in multifamily, and that's where we get the huge tax savings and let the renters pay the bills, and I love that a little bit more.
That's a good strategy, though. Flip, create the cash, turnover, roll that into long-term cash flowing assets where you get the depreciation, the cash flow, and you actually get to create a lot more wealth through commercial real estate. Like, there's nothing wrong with flipping houses or wholesaling. There's nothing at all. It's just, you got to recognize what it is. It's a business, and it creates cash.
It is a business.
Creates cash, but it doesn't create wealth, right?
It's active income. And
Active income.
one of my coaches told me this, and I'll never forget this till the day I die. He goes, "Where are you at?" And we hired a coach for flipping, and he goes, "We're doing like 4 houses a year." And he goes, "Tell me about your business." "Oh, we're doing about 4 houses a year." "How do you get your deals?" And we told him, and he goes, how do you finance it?" I said, "Well, I've been a builder for a few years. I got some money, I like, we do four, so two and two, so I got kind of got the money for that." And he goes, "Stop." And then I just sort of look, I'm telling this guy that's flipping 200 houses a year, and I'm flipping four. And I go, "But and he just leaned in the camera and goes, "Stop." And I'm like, "All right, I'm paying him a lot of money." And then he gave us, at the time was Lending Home, now it's Chiavi. And they give us a $5 million line of credit. So whatever house we did, 90% loan to value. And I was like, "Oh, that's so much easier." I go, "Well, what do I do with my money?" He goes, "I don't care." I
Yeah.
just don't put it in your own stuff. Because he taught me something that day, and I wasn't listening. And he goes, "If you got your money in the deal, when you sell the property, you're gonna have your emotions tied to that sale." And he was
Yeah.
right.
Yeah.
Right? It wasn't business for me at that time. And then once it wasn't my money, then it was just business.
Yes.
And they said, "We want 15,000 in concessions." No, we'll give you 3.
Yeah.
Okay. You know what I mean? But if it was
Yeah.
my
It's
money,
just
I'd
a
be like,
lot
"Yeah,
less
maybe the
emotion.
15 sounds good,
For sure. Yeah. Yeah. And it's also scalable. There's nothing wrong with, a lot of times I got clients that come in through the coaching program and I always ask them like, what's your capital source? So how are you getting the capital to buy these? Because it takes quite a bit of cash, right? Even though you're financing it through a bank. And often people will be like, "Well, I mean, I think I'm going to need to raise money." I'm like, "That's cool. Like, that's good. That's actually very, very scalable." Every deal that I've ever bought on the commercial side has always had investors because I know that I've got unlimited runway and I can continue to buy and buy and buy and buy. It doesn't mean I'm going to buy bad deals, but I have unlimited capacity to continue to purchase where if I'm using only my own money, it doesn't hurt to use your own money, but I'm very limited on how much I can grow. I mean, buying a few, commercial properties, whatever they are, a lot of people will get tapped out pretty fast, and I know I would have as well. So there's nothing wrong with leveraging investor capital. It definitely helps you run a better business, especially if you're responsible and think about their money and put their money first, then you should be doing a better job. What I found is when I've done things with my own cash, I'm looser. I'm a lot looser because this is my
Really?
yes, I am. Which is weird because you think that you'd be more
I'm more
careful.
tighter.
See, I'm not like give you an example. I did a deal with somebody. I trusted them. They had a lot of experience doing it was not in real estate. It was something that I was not experienced in. And I just gave him the money. We partnered on it. He was doing it with his own money. He was doing it with a lot more money of his own. So here, just let's do a JV. You handle some of my money on it. And I didn't even look at the reports. I didn't really pay attention to it. Like I don't want to say I didn't care. I cared, but I was just kind of more blind on it. Where on every single one of our deals, I read those financials very closely. I understand exactly what's going on with
Really?
every property because it's other people's money that I feel like if I lose their
More
money,
responsible?
I
Yeah.
feel more responsible. Right? Maybe it's just
Good. That's good on you, though. Okay,
maybe
you
it's
care
just
about your
blue
investors.
sky. Maybe it's because I'm like, yeah, well, I can always make my money back, but if I lose their money, then I'm screwed. But I think in general, um, yeah, I understand what you're saying. And I think when you're using your money, especially if you're cautious with your money, which is a good thing, then yeah, you will definitely be more emotionally involved in it. Or for me, I think when I'm not as emotionally involved when it's investor money, but I'm more careful.
Okay. Okay. Good. Good. I like that. I
You don't
like
want to
that.
get
That's
punched in the
awesome.
face for losing somebody's savings or sued, right? So,
No, make smart investments.
yeah.
That's really been I've been very blessed over years. I've in real estate I've only lost $6,000, and I'm very competitive, so I was mad about the $6,000.
Yeah.
And one of my coaches lost 50 million, and he goes, "Well, how much have you lost?" I go, 6,000. He goes, "This year?" I'm like, "No, my entire career." And they're like, they're looking at me sideways. I'm like, well, I only buy good deals. I don't buy a lot of deals, and I
Yes.
make sure they work. If they don't work, I jump in and make sure it's going to work.
Yeah.
And that's been, a blessing for me, but also a curse too, because, I want to make sure everything works, and I don't jump into there's a lot of deals I'm sure that might not have 100% penciled out, but you saw the worked out, killed it. The deals you missed was what I'm saying. Yeah. Everybody gets those.
Oh yeah.
But
There's deals that we've probably all passed on that
should have.
We should have probably bought.
Wasn't the guy from, I think it was one of the guys from Shark Tank was offered a stake in Uber, and he goes, "That's my greatest regret." And I'm like, yeah, I can see that.
Yeah, that's an expensive oops. But
that's an expensive oops.
Yeah.
Hey, Mario, this has been fantastic. Real quick, let's give you your last question. Next 6-12 months, what are you doing?
More of the same. We're continuing to buy. We've got several deals in the pipeline. I mean, one thing that I've learned and observed is the one who does the same, I guess it comes back to consistency and volume, right? The one who consistently does the same thing over and over and over and masters it typically does much, much better than the person who's always into something new. Now, that doesn't mean that I don't get into new things, but I would say that whenever I go into something new now, I try and go into something that's still a branch off from what I really know and what I've been doing, or how it can
learn.
Yeah, something that can work in tandem with something that I'm already doing. Instead of going into something I was mentioning before, went into something completely new, something that I wasn't experienced in, somebody else was. I've gotten hurt on those kind of scenarios. But if I start a new business, it's probably a supporting business, same industry, something that already works within my existing ecosystem. And so, yeah, I think we're just going to continue to buy more and more commercial properties, grow our fund, grow the education business, and try and continue to work myself out of my business so that
there you go.
I can focus on the fun stuff, which is sometimes in business and sometimes not. So
right. So you said consistency, and what else is your major?
Yeah, it's consistency multiplied by volume equals results.
Multiplied by volume.
Yep. So if you're doing it consistently, if you're doing a high volume consistently, it's purely a numbers game, right? But it's a numbers game over time. It's time multiplied by count gets you the results. Yeah. If you take out either one of those factors, you won't get the results unless you get very, very lucky. And I don't believe in luck. So it's pretty rare that somebody hits it big on calling one person 100 times, I
don't know if that's ever happened.
Yeah, it's pretty rare.
Hey, Mario, thank you very much for your time. We try and keep these short, but people like you, I keep on for hours. I'll respect your time. And if anybody wants to get in touch with you, how would they do that?
Yeah, I mean, active investors that want to invest in mobile home parks, they would go to getrealcashflow.com. Passive investors that want to own mobile home parks, equitygrowth.net. And search my name. I'm all over YouTube and Instagram, TikTok, and all the Facebook. Social. Yeah, everywhere. You'll just be careful. Once you do, you'll be annoyed by me. So, but would love to help anybody in any way I can.
Awesome. Thank you very much.
Yeah, thanks for having me.
Appreciate you knocked that out of the park, and I could talk shop with you for another 5 hours. Thanks a lot. Appreciate you.
Thanks for listening to Driven, the Unscripted Success Podcast. Want to share your story? Apply to be a guest at drivensuccesspodcast.com/guest.